Good evening. Welcome to our annual Strategic Asset Allocation event for 2023. My name is Chris Rudden. I'm the Head of Investment Advisory for the UK. I'm joined by Giovanni Daprà, our CEO and co-founder, and Richard Flax, our Chief Investment Officer. Briefly, we'll go through our strategic asset allocation process, which is a key part of the investment strategy. We'll have a look back at markets in 2022, and we'll look forwards at 2023 and beyond. Then, at the end, we'll touch on a few other pieces which will help people with investing decisions and touching on our new thematics offering. There is a Q&A section at the bottom. Please ask any questions that you might have. We'll touch on some of them throughout. We'll have a specific Q&A section at the end. And we have a team of investment consultants and portfolio managers who are behind the scenes who will be there to answer any other questions we can't reach as well. So, before we get going, I'd like to hand over to Giovanni, who wants to say a few words about Moneyfarm and where we are in the current state. Yeah.
Thank you, Chris, and thanks everybody for participating and spending the time in listening to us. For us, the strategic asset allocation is the cornerstone on our investment process. When I started the business over 12 years ago, we really started with the view that asset allocation was the key driver of return, and I think fast forward we still believe that's all the truth. So it's super important to focus on that, and the strategic asset allocation allows us to think, regroup, look long term, and create our assumption for the future. Moneyfarm is a period of rapid change. We've been growing a lot, even if last year has been very complex from the market, as we're going to discuss more in depth today, but we're still very optimistic on the future, and I think we are really happy to have you all on board and keen to hear all of your questions, and we're gonna approach that in the usual transparent and open way as we do. So back to Chris.
Thank you. So, without further ado, I'll hand over to Richard, who will go through what is the strategic asset allocation.
Sure. Good evening, everyone. Thank you for joining. Couple of things to touch on. Okay, move my slide. The strategic asset allocation, as Giovanni alluded to, is really an opportunity for us to take a step back, to move away from the daily volatility of financial markets and all of the news, and look out over the long term. In our case, take a 10-year view, and think about what markets would look like, or could look like, what asset classes could look like at the end of that time. And the goal really is to think about the key drivers of long-term returns, not about volatility and about how sentiment can change, but really about how economic drivers can affect long-term asset prices. And so from that perspective, we think about macro variables and we think about starting valuations. And those are really the key drivers for that long-term outlook. From there, we think about how best to combine these asset classes together. We think in terms of optimizations, we run scenarios, we have a robust debate amongst ourselves about whether these assumptions are really fair. But from our perspective, one of the key aspects of this is that it's a fairly mechanical process. We do debate the outcomes, but really the inputs are fairly mechanical. There's a relatively limited amount of judgment that goes on here. And so it's an opportunity not to be blindsided by everything that's gone on over the previous 3, 6, 12 months, but think about the long-term drivers in a very profound way and use that to drive our long-term thinking. So with that, let me turn back to 2022 and say a couple of words about where we were. As you can see, it was a difficult year for both bonds and equities. Chris will talk a little bit more about that in terms of a 60-40 portfolio. But you can see that bonds and equities were actually quite well correlated in 2022. That's not always the case. Sometimes you can have bonds going up, equities going down, or vice versa, and this is a way to help diversify your exposures. But for 2022, that diversification was much less effective. There was some diversification from commodities, but even there we can see that the volatility in commodities meant that it mattered a lot when you bought and sold those commodities. So the combination of a relatively difficult market environment for both bonds and equities and relatively few places to hide left 2022 to be a more difficult year than we've seen for quite some time.
Thank you, Richard. I actually just want to jump in on this one. So Richard has gone on to the actual specifics of 2022, the difficulties of the 60-40 portfolio, but I actually just wanted to talk about this slide here. And I really like this chart because it's really, really good. Because as an investor, the key point is perspective. And given most investors should or generally have a longer term approach, just wanted to put into perspective what a negative year like 2022 had. So, first point really is putting into perspective of history in the last 90 odd years. Basically, if we look through the 60-40 allocation, so 60% equities, 40% bonds, this one's from a US standpoint, so it'll be S&P and Treasuries. However, this one, if you look, 2022 ranks in the bottom 3 of those years. So obviously, to Richard's point, a very, very difficult year. However, the key point is if you look at the left-hand side and the right-hand side, the negative years are present and they're part and parcel of a longer-term outlook. However, people who sit through will generally enjoy the more positive years that come. At least history shows this. And we can pick out a few examples. You know, people will sit in 1974 and think, God, that was a really tough year. But people who had the 9 years that followed or whatever will have had a lot of positivity there. And I think it's a really, really positive message here that shows that actually the long-term investor will have negative years. You know, nearly 25% of those years will be negative, but that's fine because the other nearly 75 years have been positive. And so we don't believe this will change in future, and I think this is a very, very important message to take on.
There are a few things to talk about 2023. In keeping with the event, we'll focus on some of the macro drivers. And really the first point to make is around inflation. We've seen obviously very strong inflation in 2022, some of the highest rates we've seen for a generation. And 2023, we're beginning to see those rates of inflation fall. And one of the key questions will end up being just how quickly will inflation fall? So far, we've seen some good progress, particularly in the US, perhaps a little bit less so in the UK. But it's also fair to say that market participants are expecting inflation to come down. And some of that is already priced in. And over the last few weeks, we've seen a little bit of a shift in sentiment that we'll talk about, where inflation perhaps hasn't come down quite as quickly as some participants might have expected. And it's just a reminder that 2023 will be a challenging year from a macro perspective, even if we think that the broad trend of disinflation, of inflation decelerating from the highs of last year, is very much in place. The question of growth is a very interesting one, because as we turn into 2023, there was an expectation that the global economy would slow, and it has done. But actually, it's held up rather better than we might have expected. Labour markets in the US and the UK and the Eurozone have actually performed and held up rather better than might have been expected. And that's had some implications for monetary policy, but it also suggests that the underlying demand in the global economy looks rather better than we might have expected. And that's important. But it creates some challenges as well. It creates some challenges on the inflation side, and it creates some challenges on the policy side. If we think about what that means for policy, it's a bit challenging. Clearly, central banks are keen for inflation to come down. Thank you. Are keen for inflation to come down. They're keen to bring inflation down through interest rates and through quantitative tightening. But at the same time, financial markets were expecting perhaps a sharper response. They thought that central banks might be able, collectively thought central banks might be able to bring down interest rates even towards the end of 2023. And the latest economic data that we've seen suggests that this will be a little bit more difficult, perhaps. Clearly, we'll see more data in the coming months and views can change again. But as we sit here today, the message seems to be that interest rates will stay higher for perhaps a little bit longer than we thought over the last couple of months.
Maybe if I can add, so of course we discuss very often at the investment committee, and I sit in the investment committee with Richard and Chris, and the reality of this conversation, like what inflation is going to be, how it's going to impact yield, and particularly around how much exposure to fixed income we want to have in the portfolio has been, I guess, probably one of the key discussion where we spend a lot of our time and resourcing to really understand that. And specifically, actually, in 2022, our positioning of the portfolio was fairly conservative on that side, right, Richard?
No,
so
I think
we
that's
did have a benefit of effectively having a more conservative view on inflation than most of our peers had, specifically in the UK.
Let me turn to Chris now.
Yeah, absolutely. And actually, I see there's a couple of hands raised. Unfortunately, we can't take questions directly through the call, but if you use the Q&A function, please ask the questions there, and we'd be more than happy to address them there. I just wanted to touch on this slide. It's a little bit similar to the one that I spoke about before, where ultimately we have a lot of clients who talk to us and say, well, you know, we're heading into a recession, so should I be worried about markets? And to be honest, the answer is you can't really tell. If you look at history, there is no distinct pattern where recession means negative markets. Sometimes markets are forward-looking, so the years beforehand are always incredibly negative. Sometimes it's in the middle, or sometimes they just don't seem to react at all. So I think the key point really is, ultimately, we look at, we saw before 2022 as one of the worst years that we've had for some time. One of the key reasons was, a lot of expectation about moving into a recession, which probably was expected at certain points to be much worse than perhaps the outlook looks now. So the key point really is, don't really see that recession means downward markets. It can really be a very, very different situation. In fact, we probably believe, well, it's hard to tell, but obviously we've seen a lot of the pain already. And we'll have to obviously manage things in the short term, but it's not a distinct kind of, let's say, straightforward answer and say, we're gonna have a bad year this year because there might be a recession. And one other point to make actually is if you look on the years that follow recession, there is a distinct pattern there, and those are the ones that actually markets tend to rebound very, very quickly.
I would just add to that from our perspective, we do think that some of the bad news, the economic bad news that we may see in 2023 is clearly priced into financial markets at the moment. Ongoing debate within the team as to how much that is. We remain a little bit conservatively positioned, not as conservatively positioned we think as we were last year. So we do think that there is a good amount of bad news already priced into 2023, and we'll continue to monitor markets to understand to what extent we can see a bottoming of the global economy and then potentially a recovery going into late 23 and 24 and beyond. So now let's take a longer term perspective. We'll go to the strategic portfolios of 2023. First here, just a brief reminder, as I mentioned, some of the key drivers here are really global growth and our long-term assumptions for global growth, long-term assumptions for inflation, and starting valuations. And these are really the three key drivers. And here you can see just what the assumptions are for the next five years compared to the historical period. And in terms of GDP growth, it's a more conservative outlook for the next 5 years relative to what we've seen historically. And for inflation, it's a higher rate of inflation in the forecast period than was the case in the historical period. So the consequence of all of that, of starting valuations and long-term macro variables, are these expected return assumptions. These are the annualized 10-year expected returns across a range of asset classes, from developed market government bonds on the left to commodities on the right. And what you see here, a couple of things to notice. Firstly, equities look relatively good on this basis. Developed market equities with a relatively longer term, relatively high long-term return assumptions. Emerging market equities and emerging market debt slightly below. But also notable that after a number of years of relatively low expected returns, some of the pain that we saw in 2022 has translated into better starting valuations for government bonds and for bonds generally as we go into 2023. And we can really see that on this slide here. What we see here is the 2023 forecast in context, in a historical context. And it's worth bearing in mind that our process hasn't changed a huge amount, and that it's fairly mechanical. So it's not a question of particular biases coming in particular years. And what I would highlight really is the right-hand side of this chart, where you see the fixed income, the government bonds, And the expected returns here for developed market government bonds, for investment grade, for high yield, all looking well above their long-term averages. And that's really, as I said, a function of some of the sell-off and the repricing of fixed income that we saw in 2022.
May I add one thing on this slide? So I think this is really very, very important, because ultimately we've been living in the last, 15 years of very, very low, or let's say reducing fixed income returns. And I think if you have to look at the mark-to-market loss that we incurred in 2022 and you put that into context, and maybe you have a 10, 15, 20 years time horizon, the extra yield that you will get from the portfolio will more than compensate for the market loss that you had in 2022. So really, depending on your time horizon, this slide is telling us that you might actually be better off if you have a long enough time horizon, because the benefit of having higher expected return will at a certain point compensate for the mark-to-market loss. And sometimes it's very hard to think that way, but it's actually the reality of the mathematics and compounding really of investing over the long term.
So where does that leave us from a strategic portfolio perspective? And remember, these are portfolios that we look at internally really as guardrails for some of the decisions that we make over the course of a particular year. And what you do see is that as you might imagine, the lower risk portfolio is more skewed towards bonds, a greater exposure to government bonds perhaps than we've seen in recent years. Higher risk portfolios, skewed towards equities, but not really aggressively so. There's still some conservatism there, and that's really related to the volatility of asset classes that we've seen over the last couple of years. Remember that the process here is considering not only the volatility in 2022, but also volatility during the COVID period in 2020, and that's had an impact in terms of thinking about the risk-adjusted returns for particular asset classes. Nonetheless, what we can see is that the expected returns are higher than they've been in the past, and you reassuringly will see that the more risk that you take, at least in our forecast assumptions, the higher return that you should aim for.
Actually, I would like to take a moment now, because thank you for the questions that are coming in. There are some good ones, so I thought I'd address a couple now. Probably one for you, Richard. So a question here from Tony. He says, obviously we all hope there'll be a quick resolution to the war in Ukraine, although the war is likely to be long and drawn out. What could China's military support for Russia, if it happens, mean for investments?
No, an excellent question. Look, I think we should put China's potential support for Russia in a broader context. And the broader context, I think, is a world in which you're seeing an increase in conflict, rhetorical and otherwise, between China and the US. And obviously, as global investors, we have exposure in both regions, and it is a source of concern. We need to think about the long-term implications of that competition, and the Russian conflict can clearly be an accelerant for that, potentially, depending on what China does and how NATO and the US react. But it is likely, in our view at least, to be a potential source of volatility over the coming years, and something we'll need to consider as we think about the best way to construct portfolios. But definitely something that is in our minds and something that we're very aware of.
Thank you, Richard. Brilliant. And there's one here from Martin, which I'll put to Giovanni. Martin says, given that equity is the best asset class for long-term growth, why does Moneyfarm not offer a 100% portfolio? 100% equity portfolio, excuse me.
Yeah, that's a very good question, and Martin, I think that we are absolutely aligned that we should do one, and we do believe in multi-asset. So in a sense that we do believe that our P7 has enough risky asset to probably be able to achieve a higher level of expected return with less risk, or let's say better risk-adjusted return. But we also know that in the very long term, equities are a very interesting asset class, and some people like you might have a different view on the need for the multi-asset in the portfolio. So we're actually heavily considering that. So let us know and do write us an email, because it's something that we definitely are looking forward, particularly now.
Thank you, Giovanni. And one more before we continue. Very good question from Rafik. I'm going to put it to you, Richard. So Rafik asks, given how stubborn inflation is, and furthermore how persistent it is, and many developed market economies having debt to GDP ratios higher than 100%, as part of a balanced strategic portfolio, would you consider increasing the allocation to developing markets such as East Asia, India, China, and Brazil? I think it's quite relevant given our current positioning.
Yes. So when we think about our emerging market equity exposure, when we look at some of our internal benchmarks, we are overexposed or over-indexed at the moment to emerging market equities, and it's a source of much discussion. I think that some of the question I think is inflation, but it's also a broader question around growth. And so you take a step back and say, okay, well, what do we think are the true macro drivers for emerging markets and emerging market equities more broadly? And there are a couple of things to consider. From a macro perspective, we generally think that trade is what matters, that emerging markets really benefit from robust growth in global trade. And that's a little bit of a two-edged sword. Obviously, as the global economy recovers, hopefully we'll see a pickup in global trade growth. But we are also seeing perhaps increased signs of protectionism around the world. And that's something that we need to somehow offset against it. So that's one consideration. The other consideration is obviously around profitability and profit growth. Emerging markets actually their profitability has held up relatively well over the past couple of quarters. Generally speaking, you've seen margins in developed market equities come down a little bit. But so far, at least, emerging market equities have held up relatively well from a profit perspective. So I would say that the other part is around inflation. We can have a long discussion about to what extent equities are an inflation hedge. Not perfect is the answer. But emerging market equities are clearly something where we would like to see global growth really accelerate as a way to truly derive the most benefit from that exposure. But it's one that we have. It's one that we like. And broadly speaking, the discussion on the team has been whether to add more to it.
Brilliant. Thank you very much, Richard. Keep the questions coming. We'll revisit them at the end of the presentation again. But for now, we'll jump back to this, and hopefully we'll have some more questions to follow up at the end. I will address this one. So this section will be a section around, it's very short. Obviously, the key was around the portfolios, but this is around kind of attitudes to investment and kind of how to look at things in perspective, as we touched on before. This one is a chart. Basically, it shows, if we look back at history, and we look back at the worst years, again, of the S&P 500, if we look at the worst years in history, what has happened in the years that follow? Taking away the very kind of specific factors that we've discussed before, which are always relevant and always prevalent, what has generally happened in the general cycles of markets, obviously the ups and downs and the journey that you go on. And the key point that I really wanted to show here, and actually it's quite similar to a slide that Richard showed, where he showed our expected returns through time and how kind of each year they've come down until this one, which is obviously after the year that we've just had. And the key point I really wanted to show was that, bear in mind this is no guarantee of what will happen, but if we look through history, what has happened after the worst years in history? So looking at the yellow bar, which is what we call bear markets, so minus 20% or more, the average of the years that followed was around 37%. Then you take 3 years out, it's gone down, 5 years out, it's gone down, 10 years out, it's gone down even further. And the key point being is generally what you find is the best periods in markets generally come right after the worst. Whether it be days, whether it be years, months, these periods are always very extreme. And for example, we look at maybe even 2020 was a microcosm of a market cycle. And you look at how extreme markets fell in 2 months and how extreme they rose and rocketed up in the 2 that followed, then kind of obviously continued to rise at a slower rate. That's a perfect example of what we see generally on a broader market cycle. So the key point really, and again, is I touched on earlier with the kind of the long-term outlook is what the biggest mistake we see is people making rash decisions during market sell-offs. And what they tend to do is at the end they will make, they'll de-risk themselves, they'll put some money into cash, they'll stop their continuous plan because it's all about having a plan. They'll stop their plan for their long-term approach and they will miss what generally, historically at least, has always been the most lucrative part of the markets and a very key part of the long-term approach. And again, I don't see why this would have any reason to change. I would like to repeat, this is obviously not a guarantee that this year will be 37%, but again, the message is incredibly important because it's a pattern that repeats itself through history.
And can I add something to that? I think that, as you know, we don't plan to have a crystal ball. I think nobody really can predict the future, whether China is going to start giving weapons to Russia or anything else. And specifically, if you look at the last, I would say, 3 to 4 years, the volatility event has been incredible from the pandemic to Ukraine. So do you think that the real comfort we can find and the way we can help you making informed decision is looking at what consistently has happened through history, and we are going to repeat endlessly that timing the market is more important than market timing, and this is something that we fundamentally believe. We think that history has worked that way in the last 100 years, and we think that this is one of the, let's say, safer recipe to really have a long-term success in investing.
No, absolutely. Thank you, Giovanni. That's a really key point. And exactly that. I think while we talk about roadmaps, speed bumps, whatever, I think the slide again that's quite relevant was the one about recessions and what markets have done in recessions. And the key point being there is that every time people think, oh, well, I will know when markets will recover because that's when the good news will start. But to be honest, normally that's too late. And we see that often. People say, oh, we'll wait till things recover, but that means you've obviously missed the rallies that we see on screen. So,
and even year to date, I think equity indices have roughly recovered 30% of the loss that was in 2022. So even just in the period of the last 2 months, effectively. Yeah,
absolutely. In fact, markets have been kind of coming back up since October, but you don't really hear too much news about that. So it's very, very relevant to the point. So yeah, that's the point on there. And then this one, again, perhaps an aggressive title, but I think it's a really important one to really put into perspective what 1 year can do and how that really shouldn't shape your plans and your outlook. So what we see here is essentially our ESG portfolio struggled more than our classic portfolios last year. Unfortunately, it was a byproduct majoritively of the war in Ukraine, which was discussed before from the question from Tony. And essentially the key point there is obviously one of the key areas of inflation came from oil, gas, energy, which was obviously something that we work quite hard to cut out of our ESG portfolios. And as a result, the one areas, and actually which Richard showed in the very first one of the key areas of diversification, which was commodities, wasn't there. Having said that, does that mean that, if you have an ESG portfolio, should you say, oh, well, maybe I should switch to classic? I think the real answer is absolutely not, basically. If you're in there because you have a belief, you have a sense that you want to invest in change, if you want to invest in something that you feel comfortable with, we don't think that this 1 year makes a difference. In fact, it's actually something that's a bit more of a what we call exogenous shock. And generally speaking, we still believe that over a long period of time, our portfolios for ESG and classic will largely react the same, including the year that we've just had. And funnily enough, this year, our ESG portfolios have rallied back faster than our classic portfolios as part of the cyclical nature of markets that we kind of discussed before. So whilst ESG is always an important part of your kind of customization of your portfolio, investing what you believe in, don't let short periods of negative markets affect that either. Moving on, and actually that customization point leads me on to thematic investing. This is an area which we've just launched, and we think, generally speaking, it's a really, really interesting area for clients. What we look to do is we would look to offer a slightly more personalized approach to the portfolios that you can choose. This will still be managed, crucially will still be managed by our investment management team, so Richard and his team, and it will be managed in a way where it is suitable for your risk appetite. And I think that's incredibly important because it's always easy to kind of throw yourself into these high risk trends and whatever without really fully understanding whether it's appropriate for you. So what we'll make sure, is that the portfolio that you receive will always be suitable for your time horizon, for your risk appetite. So obviously then you don't have to make any kind of decisions about, is this too risky, is it not? You'll have certainty in that. And the way that we'll manage that is as part of a core satellite approach. So as I say at the top there, basically a core satellite approach is quite simple. What it will do is, say for example, you're in a level 6 portfolio. We will take out, for example, 10% of the portfolio, put in the themes that you choose that you think are interesting, and we will change the 10% that we take out will be relevant to match the risk level of the portfolio that you have, essentially. And so as a result, the portfolio will still fit your suitability.
Can I add a few?
Of course you can, please.
So I think that for us this is a super interesting development, and what problem are we trying to fix? I mean, thematic investing has been around from quite a long time, to be honest. I mean, that we're definitely not the first company that is started to offer thematic investing, and you can be done through a variety of ETF and funds and what have you. But the reality is that the value we're trying to provide to all of you is really stands in the risk management, because I think that what we care about is making sure that you have the right exposure, even by expressing some more idiosyncratic view. It's really about making sure that it fits within your ability to reach your long-term goal from a risk perspective, and that's really, really fundamental to us, which is I believe very, very new in the market across the UK. And the second point is that the complexity of really understanding what were you investing in. So if you invest in artificial intelligence ETF, you might find some stocks which are part of actually a cybersecurity ETF. And sometimes we tend to, or actually firms tend to label things in a way that is not exactly aligned with the kind of exposure. So Richard's team has done an amazing job in creating a clustering system to really effectively help you select the right team, and particularly once you want to exposure to technological innovation, you are 100% sure you are getting a diversified exposure to technology innovation and not something else. So the ability to take a deeper look at the team and understanding which actually are the components that matters, I think it's where the value that we're providing from an investment management perspective, which we think is quite innovative. It should give you peace of mind that you're actually expressing that specific view rather than just buying an instrument that potentially have also part of other things into that.
Brilliant. Thank you, Giovanni. Very, 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 very insightful. And just very high level, just to touch on the themes that are on offer. They are threefold. One is technology and innovation. I'm not going to read everything off the slide, but essentially the key points here is real kind of disruptors, things that we think will be very, very relevant in the coming years, and new technologies and things which are growing exceptionally fast. What we've found historically is obviously this is one which is probably got the highest volatility, you'd argue, just because it has that real kind of growth feel to it, but potentially that is something that is exciting for people on that one. The next one, demographic and social shifts, is a little bit more of a what we call slightly more value-based approach. There are things such as electric cars and esports, but also on the same side, things such as kind of infrastructure, aging society, and factors such as that. The slides will be shared, so obviously if you want to have a full list, you'll get the list of this, you'll actually get a recording and the slides afterwards as well, just so you can look through in your own time. And another one which is really important and actually probably quite relevant for those of our clients who have ESG portfolios, where our ESG portfolios work really hard to screen out kind of negative factors, crucially being kind of carbon emissions, etc. What this one actually does is this one allows you to take an active approach in things that will make a difference. And so on one side you're screening out, and the other side you can add a theme which will invest in the things that make a difference. Again here, looking at energy infrastructure, electric cars, sustainable water, blue economy, all of these factors. And I think this is really, really important, particularly, again, for people who have the ESG tilt, and this is a really important kind of facet for them when investing. But otherwise, everybody can obviously have it in their portfolios as well. So this is a very, very high level approach. If you have any questions about thematics, obviously we really encourage you to reach out to the investment consultant team, drop us an email, give us a call, book an appointment. We'd love to talk to anybody about it. I think it's an important point. I think it's a very important point that actually we will manage this as part of your portfolio. It's not something we charge extra for. It is just for us because we feel it's important that people want to customize different areas of their portfolio, but they want somebody to do it on their behalf as well. And I think this is a really important point.
And the other thing I would say about it is that obviously we've started with these. We think that they're important growth themes, but we'll continue to use this structure, this core satellite structure, to think about other satellite baskets that might be interesting and valuable for some cohorts of our customers. So we'll be continuing to try and innovate, be it in other baskets of public or even potentially private market exposure. So we'll continue to think about that in the coming months.
I actually have a question here just before we move on to the final point, which is related to this from Daniel. When we invest in these themes, is it through individual equities or is it still through ETFs?
It is still through ETFs, but they are perhaps a little bit narrower than some of the very broad ETFs that you find in the core portfolios.
Fantastic. Thank you, Richard. So the last point in the last section will be run by Giovanni. So Giovanni, I'll hand over to you. Is now a good time to invest?
That's always a tricky question to answer, in a sense that the challenges of always let's say reflecting our view that it's yes, it's that it's kind of elaborating why today is different than yesterday, I think, and specifically now, today what we even say with even more confidence is even definitely a better day than yesterday, because the reality is that the expected return went higher. So if you have a time horizon where you can afford to take the risk and volatility of the financial market, you should definitely consider investing now, because the expected returns that you will see are going to be, over the long term, most likely higher than what you would have seen in our prior year. So taking the benefit of these changes in market condition is one of the ways that we can, in a sense, maximize our long-term outcome and the best chances of getting a positive long-term adjusted return, inflation-adjusted return. The second point is the tax benefit. I think that the UK has a massive advantage when it comes to tax wrapper, and I still think that people tend to underuse the tax benefit, specifically now, which as the season is approaching. And just to remind to everybody, you have £20,000 every year to invest capital gain free until the 4th of April, really. So every year you can continue to use this allowance, and it's a use it or lose it, which means that if you don't use the allowance, you're gonna effectively forgo the benefit of potentially the value of the compounded returns and the capital gain tax of the compounded returns on your investment for the next 5, 10, 15, 20 years. So as much as possible, if you could use the allowance, you should use it. And specifically now, where the capital gain tax is changing and the allowances to deduct a certain amount of capital gain tax outside of the ISA wrappers is going to be reduced over time, very, very significantly. So the key thing that I think we should do from a planning perspective is try to use these tax allowances as much as we can, because the value across a long time horizon and investing period can be really transformational in the return that you get. The third point is that the inflation. I think that we were probably all shocked about the rate of inflation, how fast it has accelerated, and we probably were not used to a world where inflation remained at 5-6%, and the depreciating value that can have on our savings, on our ability to afford the same lifestyle, which investing is the natural way to try to compensate for that. Because when you're buying a company, you are buying effectively an outcome of cash flows that is much more easy to be repriced for inflation. And if you probably are aware, most of the companies raising prices, and you probably can experience that in your daily life. So participating into the equity of that company or in other asset classes that, I don't know, the linkers and a lot of the stuff we have in the portfolio can represent an inflation hedge. So inflation is something that, let's say, the cost of not investing is increasing because leaving money without being able to invest them is really, really expensive now. The fourth point is that the thematics offering that we did, I think that we definitely had the opportunity to start investing in this growth team in a point of the cycle which is quite attractive. So compared to the end of 2021, I think valuation, particularly on some of these long-term growth team, and because of the inflationary pressure, have gone down significantly. So there is the opportunity now to take advantage again, if you have a long-term view, if you can afford the time horizon, little by little. I think there is a good time to start getting into the growth team and participating into the future outcome, which was, I would say, very, very expensive to be done in the last few years. And this is a very narrow window of opportunity. Finally, I would say that to go back to the main point is that market can grow faster than you expect. I think we were probably all surprised to a degree of the rally at the beginning of the year. I think Richard will discuss it. We kind of were aligned to the view, but the reality is that the velocity of the market kind of trying to prevent the Fed or the ECB and effectively the monetary policy expectation really led to quite a strong rally, which again goes back to the point Chris was making before. Timing the market is more important than market timing, and this is just for me it's a fact of life, but I guess for we can historically it has been the case. So I do think that it's one of those considerations that if you align everything and if you have the ability to little by little continue to add to your investment, stick to a time horizon, I think specifically now we're talking about a moment which was probably better than where we were maybe a year ago.
Brilliant. Thank you, Giovanni. So we have a few minutes left, so keep the questions coming. We'll approach a few more that we've received recently. I'm actually going to touch on one that we've got from Massimo. I think it's a very good question. Is it possible for a pension-age person to combine the logic of long-term investing with a sense of drawdown while still being able to enjoy it? I think this is very relevant. A few years ago, George Osborne released the Pension Freedoms Act, which meant that people didn't have to always buy an annuity when they retired. And this allowed people to continue investing because hopefully for most people, retirement is a very long period. You know, people retire for 20 to 30 years whilst drawing down from whether it be the pension, the ISA, or whatever pots that they have. So it is important to maintain the growth because with an annuity you would buy in, you'd get the income, which is great, but if there was growth opportunities in the market, you'd be missing out. Whereas with a pension, it's almost important to sense when your retirement age is, and then how long you plan to be retired, and obviously how much income you plan to take each year. And with the income that you're not taking in the first 5 years, 10 years, 15 years, it's actually important that this money is invested for a long time horizon. And I think that's incredibly important. And, you know, thankfully life doesn't end at retirement, and actually, you know, this is the beginning of something, and, you know, it's important to make sure that that money is growing alongside as well.
And I think if I can add one thing, I mean, one of the, I guess, the recurring theme of our philosophy and what we discussed today, it's really about time. I mean, time is the best, let's say, edge to risk that you have, and I think that there is really a lot of value in time in the market. So if you can exploit that value by making the appropriate planning and to allow you to spend as much time in the market as possible, you will really, really change the outcome. That's one of the levers that you have and we have, which is probably more important sometimes than buying 5% more S&P versus 5% more Europe when it comes to actually the results of the investment strategy, the personal investment strategy over the long term.
Yeah,
I mean, it's easier said than done sometimes, but clearly the value of investing early and often is very clear, and the longer you can spend in the market, history suggests the better off you'll be.
Brilliant. Thank you, gentlemen. A good question here from Simon. Simon says, where do you see UK interest rates going over the next couple of years? Richard, I'll put that one to you.
Yeah. Only the easy ones.
Yes, exactly.
Look, I mean, we think a couple of things. We still think that UK interest rates will go up a little bit more. But we think that the Bank of England in some ways has had one of the harder hands to play of the central banks. And we can see in the way that the Bank of England Monetary Policy Committee has been voting that there is a difference of opinion within the committee. So we think interest rates will go up a little bit more. We would expect inflation to begin to come down, perhaps a little bit faster than it has done. And so potentially you will hopefully see interest rates begin to come down in 2024. Possibly before that, but we would say probably in 2024. And so from our perspective, the UK economy is still, the labour market remains relatively robust. Obviously, the cost of living is a challenge, particularly for there's a large segment of the population that has felt that very acutely. But we still think that there's a little bit more, a couple more, maybe one or two more interest rate hikes to go. But we expect to see some split opinions within the Monetary Policy Committee. So it won't be a unanimous decision, and there will be a range of views there.
It's very relevant, and obviously it's very relevant in the UK. What we find a lot of clients ask us about is, interest rates, because obviously, firstly on the cash side, but predominantly in the UK, it feeds through into the mortgage market much faster than anywhere else. Yeah. And I think this is a very relevant point. And if I understand, hopefully the view is that whilst there might be a little bit of short-term pain, it's not going to be kind of, let's say, the next 20 years of the mortgage, which will stay resolutely high. What's your thoughts on that?
No, look, without getting too specific, look, the structure of the UK mortgage market with 2-year fixed and 5-year fixed does mean that there's a relatively frequent repricing for a relatively large cohort of the kind of mortgage-bearing population. In contrast, for instance, to the US, where you can lock in rates for a much longer period of time. It would be great to see some of those longer-term rates being available in the UK. But we do think that interest rates will begin to come down in 2024. If we're right that the UK economy will slow and that some of the inflation pressures will ease. There is, and a question earlier alluded to this, this question about how quickly inflation will come down and to what level. And that still is up for debate. Our current thinking is that inflation will come down relatively quickly towards the kind of 3 or 4% level. And then the question is, how hard will it be to get towards the sort of central bank target of around 2%? And that will be interesting and perhaps challenging. But we do think that we'll see inflation come down in the way that it has begun to do over the coming quarters.
Brilliant. Thank you, Richard. And moving from UK rates to Italian rates, Giovanni, I'll ask you this one. What do you think about buying short-term Italian sovereign bonds, maximum 1-year maturity in this market, considering bank accounts are giving nothing?
Yeah, no, I think it's not a bad idea. I think that in the benefit of being according to risk and depending on where you sit and what part of your wealth, but I do think that while the UK banks have repriced deposit in a much faster way, the Italian banks tend to be, generally speaking, the Italian market for deposits tends to be much more sleepy, and rather than going to maybe let's call high yield banks, I think that today the short dated part of the govies is actually not a bad place to be. To be honest, also in the UK to a degree. Of course, if you cannot afford to keep those money invested for a longer time, because if you can afford that, then you go back to the point that you're actually using your allowance of time and you're not maximizing that return from that allowance of time with that specific pot of money.
And from a portfolio perspective, obviously we wrestle with this point because we see yield curves relatively flat, so we don't think you're getting hugely paid to take on longer duration, longer term debt. And in our portfolios, we have a range of for instance, corporate bond ETFs that in the UK that are yielding these days a pretty decent yield. And in some cases, sometimes they're accumulation, sometimes they're distribution, but the yield there is significantly better than it was for short-dated investment grade paper, and we think that continues to look pretty interesting.
Brilliant. Thank you, gentlemen. A very good one here. I think it's very relevant. It's a long question, but to cut it down, what is our view on the UK markets? So, generally speaking, obviously, we had UK markets relatively outperformed last year. They've not done so well over 5 years. What's our viewpoints? Probably breaking it down for 250 and 100, I would say.
Sure. So let's break it down. The UK market, UK large cap equities, when you think about them in a historical context, look better value than other equity markets, generally speaking. You can debate the reasons why. Some of it is perhaps sectoral. But the UK market generally has fallen out of favour a little bit in recent years. And it performed, as Chris said, relatively well last year. Some of, again, sectoral, relatively large weights in commodities. And so we are, within our own portfolios, overweight UK equities through the large caps. We think that the UK economy has its challenges, and we think that this is transmitted more directly through the UK mid-cap universe. There are a couple of caveats, obviously, around this. Some of this is about value. So if you look at the performance of UK equities, for instance, compared to some value ETFs that look at relatively lowly rated businesses, they actually have performed similarly over the last couple of years. And so, to the extent to which value is in favour, we continue to think that UK large cap equities could do relatively well. It's worth bearing in mind, though, that when we think about constructing portfolios, we don't really have a meaningful home country bias. So we think about global equities in a market cap weighted context, and in these days, UK is a relatively small percentage of that, somewhere below 10%. So we see that a lot of our peers have more of a home country bias than we do, and so we'll have a higher weighting structurally in UK equities. Obviously, having more exposure outside the UK helped us over the past 5 years. Didn't help us quite so much in 2022. But we do think that the UK large caps look relatively attractively valued. The small caps have a bit more of a challenge given the current state of the UK economy.
I think one more point on that, and on the low home country bias. I think it's also something we're very comfortable with because, particularly in the UK, most of our clients are UK based. So their job will be in the UK. They might have property in the UK. They might have other assets, which are UK based. And so if there's something that seriously detriments the UK economy, it's probably going to hit them in other areas, whether it's a lack of pay rises, whether it's losing your job, whether it's your house price going down. And so what we always like to do is we'd like to make sure that the portfolios that we have are always very globally diversified, so at least in some way, shape or form, as long as it's not something that's completely global, there'll be some offsetting effects, and not everything goes down as the UK economy suffers. So I think it's a really, really big part, not just of the portfolio construction, but also of an individual's asset allocation as well. Excellent. I think that's more or less all we've got time for. Richard, thank you very much for your time. Giovanni, thank you as well. And thank you to everybody who joined. Thank you to everybody who asked every questions. We will share this recording afterwards, so please keep an eye out. And there'll be a short survey at the end of this. It will take 1 or 2 minutes. Please, if you can answer that, that will give us any feedback to improve these events going forwards. But thank you again, and good night.
Good night.
Thank you very much.